Hi, it's John Kelly. In this module, we are going to discuss auditing the going concern assumption. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. So, what do the standards say? Well, 576 says the auditor should give it a shot. They should try. Most revealing, though, is 577, and I've quoted the whole thing here. I'm not going to read it all. But the auditor cannot predict future events and conditions, which is what you need to be able to do to determine whether or not you're going to cease being a going concern. And it states very clearly that we can't do that. And then it says the absence of a reference cannot be viewed as a guarantee that the entity will continue as a going concern. So that paragraph makes it very, very clear that the auditors can't do it and won't be able to do it. And if we don't have a going concern reference, it doesn't mean anything. We are not guaranteeing the ability of the company to continue as a going concern. The other thing I guess we should realize is auditors have no special insight into this problem. And think about it in the reverse. If auditors had a special ability to determine whether or not companies were going to succeed or fail, they wouldn't need to do audits any longer, because they would be able to apply that model to companies in the stock market, make millions of dollars, and retire early in life. And seeing you don't see anyone, let alone auditors, doing that, it should be pretty obvious that nobody, let alone auditors, knows how to do this. Now, there are some agreed upon signs. A history of losses, for example, is one that is often quoted as saying, well, if you have a history of losses, that's a red flag, and it may or may not mean that you're going to become a problem and mean business failure. The other thing about this is the market can overreact to this. And for instance, some time ago when General Motors had all their difficulties, they had a going concern note in their financial statements. And as they were required to do, the auditors called attention to that in an emphasis of matter paragraph in their audit opinion. And the market dramatically overreacted, and everybody misinterpreted, and there were headlines that said, auditors say that General Motors is not a going concern. And that's entirely incorrect. The auditors did not say that. All the auditors said was that the financial statements contained a note that described there was a problem, and it was a problem that everybody knew about. So everybody knew about it, everybody was happy about it. But the minute it showed up in an audit report, people dramatically overreacted. So that's a difficulty with doing this. And the other problem is the problem with red flags, and there's a list of them in 570A2. But red flags are often present in companies that are doing just fine, and they're also present in companies that are not doing okay. But the problem is that it's not until after the fact that you say, look at those red flags. And this is post hoc ergo propter hoc. Once the business has failed, you go, oh, well, look, they'd been losing money for a long time, so you should have known that they were going to fail. Well, there are lots of companies that lose money for a long time and become dramatically successful. Other companies don't, and it's very difficult to determine. So what are we supposed to do? Well, when we are doing our risk assessment procedures as required, we will consider, and that's the active verb, consider, think about it, if events or conditions cast doubt on the going concern assumption. So that's the first thing we're going to do. We're going to consider. And the second thing we are going to do, and some or perhaps many frameworks of accounting standards require management to assess whether or not the company they're preparing financial statements for is a going concern. IFRS requires that. Many other frameworks do as well. So if management is required to assess it, we are to discuss that assessment with management. And IFRS, by the way, just says it's IAS 125. Management is to assess going concern. And they don't necessarily have to do a detailed analysis if there is a history of profits and excess access to financial resources. And that's IAS 1.26, and it's repeated in 700A8. It's the third sentence in both of those standards. It's the same sentence in both standards. And as I said, even if the framework you're using does not explicitly require management to assess the going concern assumption, they are preparing them on the going concern assumption. It's a significant assumption. And even if it's unsaid, management should probably do it. If the framework does not require management to do it, we also discuss it with management. And the second thing we do, other than discussing with management, is remain alert. So we consider it while we're doing our risk assessment procedures, we discuss with management, and we remain alert. After we've done that, we evaluate whether the use of the going concern assumption is appropriate. And in smaller entities, there is a hint that says that if management hasn't done a detailed assessment, their in-depth knowledge of the business may replace that detailed assessment. And we would also consider the level of financial support the owner could provide. And if the owner can provide financial support one way or another, then we're not as worried about going concern. And if there's no assessment at all, it may be okay if there's a history of profits and access to financial resources, and the auditor evaluates that, and it may be done without a detailed evaluation by management. And when we're doing the evaluation, we consider if management's assessment included all the relevant information. So we're considering and inquiring and discussing and concluding. And I said concluding. We also have to think about the period after management's assessment, normally a year, and we inquire, and we have no responsibility to do anything other than inquire. And of course, if we do identify matters, that will be unusual, but if we do, we should do more things, and those things are described in 570.16. And of course, now documentation becomes really, really important. And we're probably making an accounting estimate about the use of going concern assumption, and we've probably got some uncertainty, and we've got professional judgment, and probably need to make sure that both of those things are documented very, very carefully. And if the going concern assumption is appropriate but uncertain, we would disclose it. Management discloses that, and that protects management. And then the auditor has an emphasis of matter paragraph, and that protects the auditor. Now again, the odds. If management doesn't recognize it, the odds of us finding this on our own are very, very low. The other thing is that the odds of a company with an identified problem going under are also very, very low. So the procedures are simply to ask management, and therefore it's extraordinarily important that we document what we've done, and we've documented that we've complied with each of the detailed steps, the detailed inquiry steps required by professional standards. So it's very important that we have documentation. And again, what should we document? We should document that matters were considered. We should document our discussions with management, and perhaps the end result of those discussions are documented in the rep letter, and that's a good place to have it. We have to document management's assertion that the enterprise is a going concern, and again, that can be in the rep letter. And we need to document our evaluation, and that's probably going to be in a checklist. And we need to document our conclusion. And again, at the end of the completion of a checklist, we could document our conclusion that we think things are appropriate. Now, what makes this 570 revised is not so much what's in this section, because we really continue to do pretty much the same thing we did as before. It's the big change in the audit report, because there's a new audit report and automatic mention of going concern at all times. There are two additional sentences I don't think they really change much. Certainly important to document both of these things. Paragraph 17 is added. It says we are to evaluate if sufficient appropriate evidence has been gathered to conclude on management's assertion. That kind of duplicates what's in 12, 14, 15, and 18, but document that you've come to that conclusion. Second change, paragraph 20, if conditions are identified that could have affected going concern, but they don't, are they disclosed if they need to be, and again document. And of course there's lots more guidance on the form of opinion because it's different than it was before. So, thanks for listening.